It's important to understand that when we talk about this game of rehypothecation of paper, where the Western system has been rehypothecating or suppressing the price of gold and silver, and we can talk or debate about what the reasons are, but they have done so using the leverage of paper contracts sold over and over and over and over and over again to the same players. That right now, as an example, there are 279 million ounces of silver stored on paper in London, but only 36 million ounces are actually available. So that means that the other 243 million ounces belong to players like the Bank of England or ETFs or whoever. They're not for sale. But this is standing against 380 million ounces in outstanding spot delivery contracts. 36 million ounces available, 380 million in paper, 10 times plus the leverage or the amount of deliverable contracts than there is gold. And so you have to wonder, is it really a T+8 week situation now because of trucks and manpower, or have they been caught with their hand in the cookie jar? They're 90% short on their ability to deliver. And in silver, Adam, it's even worse. In silver, the LBMA silver stockpile suffered its largest monthly decline since records began, down 8.6% in 1 month to 270 million ounces. So they have 270 million ounces available to be delivered, yet they're trading 2.9 plus billion ounces per day. That's 3.5 times annual global mine supply per day. These are the commercial banks that forever have been able to suppress gold and silver with leveraged futures contracts, naked, not backed by the actual metal to deliver, because these banks had the ability with massive checkbooks, really just to overwhelm very large interests. And largely, these interests are believed to be sovereign wealth funds, family offices. In fact, when you take a look at the number of deliveries that are coming that are not for the banks, so the bullion banks are selling to other players. These other players are non-bullion banks. 17.5 million ounces of silver was transferred this month in New York from bullion banks to non-bullion banks, making it one of the largest transfers in COMEX history. And it's not the bullion banks. These are very sophisticated traders that are standing for delivery. And they're standing for delivery in London, and they're standing for delivery in New York. But what is really different is my entire career, no one stood for delivery. And I've been doing this 35 years. Nobody stood for delivery. So at the same time, the public is going all in on Bitcoin, on NVIDIA, on Apple. You have the smartest money in the world.
Let's get right into what's really happening behind the scenes in the gold and silver markets. And let me tell you, it's nothing short of explosive. The first thing you've got to understand is this. What we're witnessing is not gold and silver going up, it's fiat currencies going down. And that, my friends, is the critical lens through which we need to view everything right now. The dollar, the euro, the yen, all of them are rapidly losing purchasing power, and the people who run the system know it. They see it unfolding. And instead of shouting it from the rooftops, they're silently preparing for the inevitable. Let me explain something that should concern every investor. Central banks are not just buying gold, they're selling fiat. That's what they're doing. When they accumulate gold, they are actively getting out of their own currency systems. They're diversifying away from the very monetary structures they oversee. Think about that. These are the institutions that issue and manage our currencies, and they're hedging themselves against those same currencies. It's not about gold becoming shinier or more fashionable. It's about trust in fiat evaporating. The real story here isn't about a bull market in precious metals. It's about a bear market in credibility. The average person still doesn't understand this dynamic. They treat gold like a tech stock, looking at day-to-day movements, jumping in and out on speculation. They watch the price tick up to $3,000 and think, maybe I should sell now, lock in a profit. But let me be crystal clear. If you're selling gold at $3,000, you're not just taking profits, you're buying dollars. And in my view, that's like jumping from the Titanic into a life raft with a hole in it. You're getting out of the safest monetary vehicle we have, real money, and diving headfirst into a currency system on life support. Why would you do that? And then there's silver, our misunderstood, underpriced, and criminally ignored cousin to gold. Look at the gold to silver ratio today. We're pushing levels close to 90 to 1. That's insane. Historically, that ratio has averaged closer to 40 to 1, and during bull markets in precious metals, silver has been known to outperform gold 2 to 1, sometimes even more. And here's the kicker, there is no premium priced into silver today for its monetary role. Zero. It's being treated like an industrial commodity. But silver is more than that. It's money. Always has been. Always will be. Now think about the implications. In a currency collapse, silver is going to become the go-to option for day-to-day barter and smaller transactions. If governments crack down on gold ownership, and they might because desperate governments do desperate things, silver will be the monetary lifeboat for the average citizen. Why? Because it's less regulated, less centralized, and far more practical for everyday use. Plus, let's face it, politicians don't understand silver. They barely understand economics. They see gold as a threat to their monetary control, but silver flies under the radar. For now, let's pivot back to the big picture. We've been seeing massive drawdowns in the LBMA and COMEX vaults. The physical metal is vanishing. The paper market is being stretched to its limits. We're watching a slow-motion bank run in real time. Everyone from sovereign wealth funds to family offices and ultra-high net worth individuals are lining up. Not to roll futures contracts, not to speculate, but to stand for delivery. And that's not a small thing. I've been in this business for over 3 decades, and for most of that time, nobody, and I mean nobody, stood for delivery. That's changed. Now it's happening at scale. And who are these people standing for delivery? They're not retail investors. They're not folks buying 20 ounces of silver or a few gold eagles. These are serious players. The kinds of institutions and individuals that don't make moves without full due diligence. They're well-informed. They're well-connected. They know something the rest of the world hasn't figured out yet, or maybe refuses to acknowledge. You have to ask yourself, why would a sovereign wealth fund go through the complexity and cost of standing for delivery on a COMEX contract when they could just call up a bullion dealer and wire $50 million? What's the point? The point is removing counterparty risk. They don't want paper. They don't want promises. They want the metal. And not just allocated accounts. They want it in hand or in direct vault control. That's the difference. The system is cracking. The leverage is absurd. In London, as I mentioned earlier, we've got over 270 million ounces of silver technically available, but we're seeing 2.9 billion ounces traded per day. That's 3.5 times annual global mine supply being churned through on a daily basis. That's not normal. That's not sustainable. That's fraudulent. And it's a matter of time before the whole thing buckles. Here's something else the mainstream won't tell you. Banks like JP Morgan are deeply embedded in these markets. They're not just participants, they're the architects. They manage gold. They control massive silver positions. They were fined nearly $1 billion for manipulating these markets. And yet they're still here, still operating, still running the game. But lately, if you've been watching closely, they've been pulling metal out of GLD. That's not an accident. That's not profit-taking. That's exit strategy. Think about Judy Shelton. Think about the policy direction if Trump gets back in office. We're hearing whispers, loud ones, about gold-backed treasuries, about 50-year gold bonds, about restoring trust in the dollar via partial backing with real assets. If that happens, and I believe it will light a fire under gold like we've never seen. Not because gold becomes sexier, but because it becomes policy. It becomes part of the structure again.
And let me make something very clear. It would be far easier for someone to write me a check for $50 million to buy gold and silver than it would be to stand for delivery on COMEX or the LBMA. You are talking highly sophisticated traders. And I think the common denominator in highly sophisticated and very wealthy is they know the information. Who are the sovereign wealth funds? Is it the central banks wearing a different hat? Or the commercial banks wearing a different hat, or the very, very, very connected wealthy elite taking $4 billion in delivery onto COMEX from JP Morgan, who only does it on behalf of customers? So my point is that I don't care what market you pick, the insiders always move before the public. Is it ironic that the insiders are selling 6 to 1 and the hedge funds have their lowest exposure to the Mag 7 since for 22 months at the same time the public's moving in that direction? Or how about what has the public been jumping into for the past 2 years as the central banks net have been selling? Oh yeah, that's U.S. treasuries. 7 trillion record in money markets, all invested in treasuries. While the most well-funded and, more importantly, well-informed traders in the globe are not only copiously accumulating gold and silver, the point I'm trying to get across is the repatriation, the taking possession of, removing counterparty liability. And in a world that is so systemically interconnected, incestuously so, that's a problem when dominoes start to fall. To your point, what could happen? Well, these bullion banks aren't just bullion banks. They're the biggest banks in the world. And these are very, very large Western money centers. You could say it's Deutsche Bank, UBS, Standard Charter, at the big European banks, or you could say it's Bank of America. Is there any coincidence that Warren Buffett's been dumping all his Bank of America? And Ted Butler, a fantastic gold and silver analyst of the COMEX who passed away, God rest his soul, before he died 6 months ago, was screaming that it's Bank of America who has 1 billion ounces short on paper in silver and 30 to 40 million ounces short on gold. Now, I could go into a long discussion why I believe silver has been manipulated, and I would say gold has been manipulated for a very long time for something called Gibson's paradox. It's the inverse relationship between real interest rates and gold. And forever, they suppressed gold because they maintained a situation of an illusion of wealth in a low interest rate environment where people's stock portfolios and their homes and 401ks all went up in value because rates were suppressed. It created distortions in asset prices and misallocations of capital and resources. Well, if you do that, you have to step on gold, because if gold doesn't pay a coupon or no return, well, low interest rates, Gibson's paradox would say, well, gold should be going much higher. But if you have very high interest rates, well, Gibson's paradox would say, well, you can buy treasuries with safety. The only difference this time is who wants to buy treasuries from the nation who's the most largely indebted nation on the planet. They've gone too far, and they suppressed interest rates for too long and created these distortions.
And that brings us to the current state of chaos and opportunity in the precious metals market. Now, I want everyone watching or reading this to understand something crucial. What we are witnessing right now is not merely about gold and silver going up in price. It's about a total breakdown in trust. Trust in paper markets, trust in fiat currencies, and trust in the old mechanisms that have kept this illusion of stability going for decades. The Western financial system, led by the United States and the City of London, has long used a kind of alchemy, turning air into metal, or at least the illusion of it. They've done this through the issuance of unbacked paper contracts. We're talking billions of ounces of silver being traded daily on the LBMA, while only a tiny fraction of that metal even exists in deliverable form. That's not hyperbole, that's fact. We're in a situation now where the leverage is unsustainable. Imagine trying to play musical chairs with 10 people and only one chair. That's the level of insanity we're talking about when you look at COMEX and LBMA. For example, in London, 279 million ounces of silver exist on paper. Only 36 million of those are available for delivery. Let that sink in. Against that, there are 380 million ounces in delivery contracts. You don't need a PhD in economics to realize this is a ticking time bomb. That's not just tight, it's a systemic vulnerability. It's a setup for a failure to deliver. Now, why is this so important? Because the game is changing. Unlike 10 or 15 years ago, when this manipulation was met with apathy or ignorance, now we're seeing the most well-informed, best finance players in the world saying, we're done. Sovereign wealth funds, central banks under alternate umbrellas, billionaires who don't trust fiat anymore. They're standing for delivery. They're not taking paper. They're taking the bars. They're not asking, how many contracts can I roll over? They're asking, where's my gold? What makes this even more fascinating is that the public is, once again, missing in action. They're off chasing Nvidia and Bitcoin, caught in a dopamine loop of risk-on trades, while insiders are dumping stocks at 6-to-1 ratios. What do the insiders know that the public doesn't? What do the sovereigns and elite family offices understand that your financial advisor won't tell you? They know the music's about to stop. They're preparing for what comes next, when confidence dies. That's why we're seeing unprecedented withdrawals from COMEX and from London. We're not talking about guys stacking 10 silver eagles here. We're talking multi-billion-dollar transfers out of the bullion banks. And keep in mind, JP Morgan doesn't just do this out of goodwill. When they pull metal out of gold or silver, they're not speculating. They're executing. They are the custodians of that metal for some of the most powerful players on the planet. And if they're redeeming those shares and pulling the actual bars, you better believe it's for a reason. Now let's talk a little bit about silver specifically. It's often referred to as poor man's gold, and there's some truth to that. But here's what people forget. When silver runs, it outperforms everything. In 2011, when gold hit $1,900, silver hit $50. Now gold is at $2,900, more than 50% higher, and silver is sitting at $50, around $32, which is 40% below its previous high. That's a spread that doesn't make sense if you believe the metals are moving together. And guess what? That spread is already starting to close. According to Andy Schectman momentum analysis, when silver hits that 2% level relative to gold, a very normal historic level, it's a game changer. If gold's at $5,000, which is well within the realm of possibility if the US moves toward gold-backed sovereign bonds like Judy Shelton and others have proposed, then silver could easily be sitting at $100 or more. And that's without any real monetary utility priced in. If silver regains even a fraction of its historical monetary role, as a hedge, as a reserve, or as legal tender, it's off to the races. Here's the kicker. If we do see a revaluation of gold, which is becoming more than just a fringe theory, you can bet that silver is going to get pulled up alongside it. Central banks may not be accumulating silver like they are with gold, but retail investors will. They always do, especially when the world starts to wake up to what's happening in the treasury market. You know what the public has been piling into the last 2 years? Treasury ETFs, money market funds backed by treasuries, $7 trillion parked in instruments that are being actively sold by the smartest traders in the room. Why? Because they see the writing on the wall. They know the Fed can't raise rates high enough to stop inflation without blowing up the banking system. And yet they also can't keep printing without destroying the dollar. This is the corner. This is checkmate. And the only way out is a new system, probably a blockchain-based system backed by gold. Maybe even issued by the same players who are currently pretending everything is fine. And let's not ignore what's happening in geopolitics. Nations like Russia, China, Turkey, and even smaller countries in Africa and the Middle East are dumping treasuries and buying gold hand over fist. You know why? Because they know that the dollar's weaponization, via sanctions and reserve freezes, is a game that's only going to work once. After that, everyone finds an alternative. That alternative is gold. Not crypto, not the euro. Gold. Just look at what's happening with trade settlement. The BRICS nations are developing gold-backed trade platforms. Saudi Arabia has openly discussed moving oil sales into yuan or other non-dollar alternatives. The petrodollar system is on life support. And guess what? That's the system that props up the dollar as the world reserve. Once that goes, it's game over for dollar supremacy. So where does that leave you? The average person who's trying to protect their family's purchasing power, navigate an unstable financial system, and avoid being the last one holding the bag, it leaves you with 2 words: tangible assets. Not just any asset, real money, gold and silver. Because gold doesn't default. Silver doesn't require a central bank to guarantee its purchasing power. These metals have survived every failed currency, every debt jubilee, and every regime change in modern history. That's why we're seeing central banks accumulate gold at the fastest pace since Bretton Woods. That's why countries are building domestic storage facilities and pulling their gold out of London and New York. That's why premiums are rising, delays are growing, and delivery defaults are looming. And that's why, if you're paying attention, you need to act. Don't wait for CNBC to tell you gold is a good buy. Don't wait for your financial advisor to give you permission. And don't wait for the Fed to admit what's really happening, because they won't. By the time the system acknowledges the problem, it's too late. You want to be early, not sorry. Gold and silver aren't just investments, they are lifeboats. When this over-leveraged, over-promised, over-delivered system finally resets, when confidence evaporates and liquidity dries up, you'll be glad you had a chunk of your wealth stored in the one form of money that's been trusted for 5,000 years. This is the time to get serious. This is the time to front-run the revaluation, because when it comes, it won't be slow. It'll be a Friday night, Monday morning event. Bang, game changed. And those who weren't ready, well, they'll be left behind.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.